Hi, thanks so much for tuning in to BQ Prime for this special coverage of Budget 2023. This show is specifically for you, the individual taxpayer. Every year we look at the budget and we wait for the statement from the finance minister to find out that small bit that refers to the individual taxpayer in the hope that there will be some lessening of the burden, particularly for the middle class. And that is exactly what Finance Minister Nirmala Sitharaman said she has tried to achieve in Budget 2023. There's a lot to unpack in the form of the several changes to the new tax regime and a few other changes in terms of how a few assets are looked at in terms of capital gains treatment. My panel is going to break all of that down for you so that you understand it. Don't forget to tell us what you think in the comment section in the meanwhile, and we'll try and take a few questions live. My guests today are Rajesh Gandhi, who's a partner at Deloitte. We've got Harshvardhan Roongta, who's a co-founder of Roongta Securities, and we've got Arvind Rao, who's the founder of Arvind Rao and Associates. So, gentlemen, we must start with the big announcement for the individual taxpayer, and that is the change or the reconstitution, if you can call it that, in the new tax regime. And this is done with a goal of incentivizing people to move from the old tax regime, something that hasn't happened yet. Do you think that people will make that move now?
The good question. First of all, I do agree with you, Alex, that the move has not happened so far because of various deductions which individuals are able to claim. But in this new regime, there are a few benefits. One is for those earning above 5 crores, the surcharge reduces from 37 to 25. So that reduces my effective tax rate to about 39%, which is a good delta of about 4 or 5%. Second is for those at the middle income bracket of between about 8 to 10 lakhs, they now have to pay a tax rate of only about 10%. So again, that makes it quite attractive. And the basic exemption, as the FM said, along with the rebate, it's actually 7 lakhs and not 3 lakhs. So I think all in all, I would feel that yes, I think more and more individuals, particularly in the lower income bracket of 8 to 10 and those above 5 crores, would want to move to this new regime to take the benefit. I think it has made it more attractive, and that was the intention.
Absolutely. And in fact, just to list out a few of the changes you mentioned, that was the introduction of the standard deduction for the new tax regime, which is quite a benefit. And also the change to bring the non-taxable income in the new tax regime to 3 lakh rupees. So effectively, it can be said, gentlemen, 3.5 lakhs is non-taxable. And for 7 lakh, as was just mentioned, you don't have to pay tax effectively. You'll get that tax back in the form of a rebate. Now, I was actually doing a little bit of number crunching before we started this conversation, and I looked at income of up to 10 lakh rupees, Arvind. And it is quite a substantial shift from the old new tax regime, if you can call it that. But can you say with certainty now that the deductions that made the old tax regime so lucrative are now maybe not as lucrative as before? So if you're not claiming HRA or if you're not claiming Section 24, you might as well move to the new tax regime.
I think before I answer that, Alex, if you remember when we did the pre-budget session, we did speak about this, that the new regime needs a bit of more incentivizing people to get adapted to that. And I think the good part is it has been heard and it has got implemented. So yes, as in if you look at in a numerical manner, it does look like the ATC bracket of deductions is something that is now getting covered by raising the rebate section. So yeah, only if you have like the HRA or the home loan interest, or even let's say the Mediclaim deductions, and you intend to maximize that, then yes, the old regime will look better, but otherwise the new regime is giving tough competition.
Absolutely. All right. But you know, Harsh, I kept you for the last because we have insight from the personal finance side of things as well. It's not just about tax and saving tax. You have said, and I think a lot of my guests on personal finance conversations have said, that investment should not be made with the intention of saving tax. They have happened in that manner in the past. But now, if people are moving towards the new tax regime, the onus is now completely on them. is it now more important than ever before for people to look at their retirement savings very carefully, especially if they are moving to the new tax regime?
Yeah. So, very clearly, Alex, you must understand that earning and paying taxes on that is one element. Okay. And that should be treated independently. You look at the other element of your personal finance, which is saving for certain goals. Now, you would have retirement, you could have, your life insurance needs. I mean, you need to protect your family from all the risks that you run on yourself, right? So, those things need not be clubbed together. Essentially, it should not be clubbed. Why it had been happening till now? Because the government wanted to incentivize people and motivate them. Like, look, I am not able to give you a social security, net under the health insurance for that matter. So why don't you go out and buy it yourself? So I'll give you 80D benefit, right? So you want to incentivize people and motivate them to go to do something, and that is why there was a tax break given. Now, I think we are all matured enough to understand that even if I'm not getting a particular tax benefit on a particular investment, does it mean that I will not invest in that? I mean, I will invest because I have certain requirements. So I think it's time to understand that as of today, at least for the next financial year, both the regimes are going to be in concurrently running. Okay, so people will still be incentivized to say that I will invest only if I get tax benefits. But take it for sure, I think given a year or two, I think the old regime is going to be completely taken away. I mean, it's going to be removed rather than given an option.
It's interesting that you say that, because there was a very clear statement today that the new tax regime would now be the default. What is the significance of that statement? Are we in fact moving in the direction that Harsh just pointed out? We're going to phase out the old tax regime.
No, actually, I did want to make a mention of that. You're absolutely right, and Harsh is right. The new regime is now the default regime, which means that, by default, the new regime will be applied unless you want to claim reduction in incentives. And this is in line with the government's philosophy, even for corporates, to phase out exemptions and deductions as much as they can, and then reduce the tax rate. New manufacturing companies, as you know, 15%. Now, cooperative societies can also get that benefit. And if the government wanted to continue with the program of incentives, they could have very well given to so many sectors. In this year, for example, the FM announced, like, for example, tourism sector, employment for women. They could have easily given infrastructure, they could have easily given deductions. But I think they have refrained from doing that because their philosophy is to simplify the regime by giving lesser exemptions and deductions and then try and slowly move to a lower rate.
Okay, so we've spoken about the new tax regime, and seemingly we're moving in that direction. Perhaps next year, this time, when we have this conversation, we will likely no longer be talking about the old tax regime. But, let's move on from the incentivization, shall we say, of the new tax regime. There were a couple of other changes. One had to do with real estate, or residential real estate specifically, and the capital gains treatment of that. Could you break that down for us?
Right. So today, as you know, you can get deduction or incentive, to use the words, for buying a new property, both under section 54 and 54F. 54 is an exchange of old property against new, and 54F is for capital gains on sale of securities, which you can use to buy a new house and get a deduction. Now, again, maybe partly to do with trying to reduce the amount of incentives given, and also partly, I think, to try and reduce the excessive benefits which HNIs might be taking. There's a cap which has been provided for both 54 and 54F to say that your total investment under both these sections should not exceed 10 crores in totality. So which means that only if you buy a new house up to 10 crores, you can get the benefit. Over and above that, you will lose the benefit. So again, I think in line with what you mentioned earlier, and this doesn't impact middle income earners. I guess, it's more for HNIs, and that's the intention.
Yeah, because that's a very large amount of gain that you would get. Speaking of personal finance and budget per se, there's a lot that can fly under the radar, and that's why it's so important to look at the fine print, Arvind. There was another mention with regard to real estate. What was that?
So, and this is a very interesting point because although it was never mentioned in the act per se, but this is something that came out of a judicial precedent wherein it was said that all of us are aware that you claim the interest that you pay on your home loan as a deduction under section 24 up to the limits. So this judicial precedent said that at a later point when you're selling this property, you could also claim this interest as cost of acquisition and also reduce it from your taxable gains. Now, somewhere this has been taken notice of, and the current bill says that this benefit will not be allowed. That is, claiming the interest again as a deduction in the capital gains is not allowed to the extent you have claimed benefit.
Okay.
So, since this is a lesser known benefit, I think the positive way to look at it would be that all those who have not used this can definitely now look to utilize this unclaimed interest as a deduction in their capital gains.
That's interesting. Let's quickly move on to the insurance side of things, because I think a lot of people were talking about how this budget is perhaps a little negative for the insurance industry. I guess we can unpack that at some other stage. But let's talk about the capping of the gains from insurance products outside of ULIPs. Why was this necessary, and what is the cap that has been introduced, Harsh?
Yep. So, ULIPs had already, there were some changes made to the ULIP taxation last year itself. So what has happened this year is that all your non-ULIP policies, so they are your endowment policies, money back, your whole life policies, etc. If your annual premium is more than 5 lakhs, and this is at an aggregate level, so it's not that you buy just one policy of 5 lakhs and above annual premium. If across insurance companies, if you're paying more than 5 lakhs, okay, so it'll be clubbed and it's linked to your PAN, so they easily know that you're paying more than 5 lakhs. Then the maturity proceeds that you get, which earlier were tax exempt, now they will be taxable. And this is only in case of maturity. So,
Right.
Very clearly, it does not apply to death benefit. So, if the policyholder passes away and the death benefit is given to the family members, then there is no tax implication. It continues to be tax exempt under section 1010D. However, in case it goes up to maturity and you receive the money and you've paid 5 lakhs and above annually, then the entire proceeds will be taxable.
In your experience though, Harsh, are there a lot of people who do claim that amount? Because it is a very large amount of premium to pay in a year.
Well, you'll be surprised, Alex, that, India is a very vast country. And seemingly, you'll find somebody thinking that, he may not be having this kind of investment, but you'll be surprised to know the kind of money that goes into insurance policies.
Interesting. All right. There is one more point, and I'll bring this to you, Arvind. It has to do with the change of the threshold in this senior citizens savings scheme, right? And this is something that has been called for quite a while, because it is a great avenue to park funds for senior citizens. Tell us about the threshold change and why is it significant?
The threshold is significant because it has actually doubled. So till date, senior citizen could invest up to 15 lakhs in the scheme, and the madam has now has doubled it. So now they can go up to 30 lakhs. So it's interesting and a very good incentive is because senior citizens have always been complaining that there are no sufficient avenues for them to invest in a risk-free manner. And this being a government scheme is the perfect bet. Alex, if I could add in that, even for senior citizens, the enhancement of the limit in the post office monthly income scheme, which has also been doubled from 4.5 to 9.
Yeah.
And in case of a joint account, it has moved
15
from
lakhs.
9 to 15 lakhs. So I think it's a good jump in the small savings segment that every senior citizens, and in case of MIS, even non-senior citizens could make use of.
Do you want to weigh in on this, Harsh? How should a senior citizen now with the enhanced limit look at the senior citizen savings scheme vis-a-vis other instruments available in the market?
Yeah, so in our practical experience, Alex, has been a real pain point where once you're crossing 60 years of age, you get your retirement benefits in your hand. So suppose a person retires with a 1 crore corpus. Now, how do you deploy that money to get regular income? Okay, we may have products which say on the debt mutual fund side that they're likely to earn this kind of return over a period of time. Then if there are any payouts, how do you get them? Most of the people do not understand the mechanism. And given the fact that they don't have much choices, they would go and subscribe to it. Now, in this case, when your limit goes up to 30 lakhs per individual, so as a family, as a couple, you can go up to 60 lakhs rupees. I mean, this is an excellent investment tool for somebody who likes a fixed interest. Okay, so this gives you clarity of what you're going to get. So it says that you will get 8%, you will get it quarterly.
Predictability.
Yeah, you'll get quarterly and you'll get for 5 years. So that is what senior citizens like. And in the absence of a limit which is beyond 15 lakhs, what do you do with the rest of the money? So then you would have to go to banks, go to post office, MIS, go to all those areas. And then at the end of it, you will go to some debt mutual funds or some products that you're not understanding clearly. So I think it's a brilliant move. It's the maximum limit. It doesn't say that you have to forcibly invest all your retirement savings into it. So those who like it, I think it's an excellent move and it should be very wholeheartedly welcomed.
Yeah, certainly. And because the calls to increase it were because people wanted to put more money and could not. I'll come back to you, Rajesh, on this last bit. And before we kind of wrap things up, it's not really something that will be of interest, or rather, a lot of my viewers may not know about this. So the market linked debenture and the change in the taxability of that, how would you explain it? Because it was being taxed like an equity instrument, and the attempt seemingly is to correct that, because it effectively is a fixed income product, or rather a bond. You earn coupon from that or interest from that, and you're paying taxes as you would pay on equity.
I think you're very well said, because the whole idea is that you earn a fixed income on the market linked debentures or MLDs. Normally, fixed income would be taxed at the slab rates, going up to 30%. But the way MLDs were structured, they were listed instruments, and you did not get a coupon, you got an amount on redemption. And generally, the redemption used to happen after 3 years. So these debentures were therefore long-term listed securities, which enabled investors to get a 10% tax rate, which is otherwise available for any other listed security. This made MLDs a great product because your post-tax returns were significantly higher compared to your other kinds of debt instruments where you had a 30% shave off clearly. I don't know if you can call it a loophole, but the government wanted to correct this kind of a situation because, as you said, it's a fixed income. So what they've said is that any returns on MLDs will be deemed to be short-term capital gains, and there's an inference in the memorandum to say that it will be taxed like derivatives, which means that you don't even get your 15% tax rate, which is available for listed equity or listed equity-oriented mutual funds. They will now be taxed at the slab rate going up to 30, and with surcharge going up to 39, and in the case of foreign companies going 40% plus. I would think this will significantly make MLDs they lose their attraction to a large extent, and people might want to look at other kinds of instruments.
I was going. That was going to be the last point, but I recall that there's one more change, and hopefully you've read about it. Is the tax collected at source for the liberalized remittance scheme. I ask about this, gentleman, because there was a lot of interest for investments through that route, because the SEBI and the Reserve Bank of India has kind of closed the gates for investments through mutual funds. So people were looking at LRS as an opportunity to invest in equity abroad. How does this change things? And who would like to take? Harsh can take it.
Yeah. So what has happened is that tax collected at source, initially it was 5%. So,
yes.
Okay, let's start from the beginning, saying that I as an individual, I can invest overseas up to $250,000 every year.
Significant amount.
So that's a $250,000 under the LRS, the liberalized remittance scheme. I can invest into assets overseas. Now, when I remit that money, I was to deduct tax. So that was at 5% until now, which has now been enhanced to 20%. So say, for instance, I'm sending out $10,000. I will get investments worth $8,000, and $2,000 will be in the form of a tax deducted. So this is one thing that has been there. But let me just add one point here. If you're remitting money outside for educational purposes
or medical
for medical purposes, then the TCS remains at 5%. Yes. And if it's been financed, education loan has been financed through an institution, then 0.5%. So this is only for investments under LRS that the tax collected amount has been increased to 20%.
You'd like to make? Yeah. So I have 2 points to add to that. One is it's a TCS, which means the person who is sending the money will get that amount as a credit against his normal income. And it's as he said, it's an amount which I'm investing abroad generally. It's not an income for me. So I don't understand really why the rate. I can understand why the rate was introduced at 5 to monitor, outbound investments and keep a track and report. But I don't understand why the rate was increased from 5 to 20, because this is not a tax on income, right? So while you will get a credit, but it's a cash flow issue.
So correct me if I'm wrong, but certain investments that you can make through the LRS scheme, Arvind, would effectively be taxed similar. I'm talking about capital gains here, similar to fixed income mutual funds where you have indexation benefits after 3 years. How would this change affect that in any way?
No, it wouldn't, because it's only affecting the money that is actually getting invested.
Right.
So it doesn't affect the taxation part of it. But I'd like to add something on
Sure.
this, which is this is a very valid point on the LRS. At least we are trying to invest. But I think the bigger damage, adding to what Rajesh said, is which is inexplicable for me, is that this 20% has also been made for the overseas tour package.
Okay.
So if you're trying to book a foreign holiday, today there is a 20% TCS. So it kind of shoots up your budget like straight from 5 to 20. So again, inexplicable.
So okay, but let me close the loop here for people to understand this. How does this work? How is a tax collected at source? And what does a credit mean? Do you get that money back eventually?
It's like a TDS. So the
Right.
tax will be collected with the bank, but then it is like a TDS credit given to you. It's a different mechanism of paying the tax. And at the end of the year, when you pay your advance tax, etc., you can claim it. And if you don't have a tax liability, you will claim it as a refund.
Understood. All right. So seemingly it is a measure to try and get a wider tax net. Maybe you can interpret it in that manner. Closing comments, gentlemen, and I'll go from right to left. Do you think that a balance has been struck? On balance, more positives than negatives, if any negatives were there?
My personal view is that budget cannot be an annual exercise where you keep on making a lot of changes. So I think the government has met that objective. Minimalistic changes wherever tweaks were necessary were made. Of course, there are always opportunities and we always keep on complaining. So there were a few areas. For example, there was one on section 194 LC and LD where investors were getting a 5% rate on any investment in government securities bonds. Everybody was hoping that would be extended because we need foreign capital. That has not been done, and there are certain other areas. But I think overall, I would think it's a good budget.
Harsh?
So very clearly the government has laid out the growth trajectory. I mean, they're saying that we're going to spend on infrastructure, we're going to spend on XYZ areas. And one of the components of GDP is the government spend, right? So you have to, keep a very close eye on that. The good part again is the fiscal deficit numbers. I mean, they're containing it, they're meeting those targets. Then they're giving a clear view saying that in 2025-26 they'll be at 4.5%. So I think they're very clear indications, and they're also meeting those targets.
Sure.
So on the macro level, I mean, the indications are very clear that growth is going to be the area of focus. On the personal level, I mean, giving more money leaving more money in the hands of the people is going to boost consumption. I mean, but obviously we're coming with a caveat saying that, okay, you must continue investing. I mean, don't forget that just because government is not giving you tax benefit doesn't mean that you don't plan for your retirement, right?
True.
So I think overall there is a balance. I mean, if a generic rating per se has to be given, I think it's on the positive side. I don't think there's any significant negative to look at in that sense.
So specifically for the individual, Arvind.
I think the biggest takeaway for me here is that there are no negative surprises. So there's no new tax that has come, but there is a relaxation in terms of the slabs, enhancement of the investment limit. So I think for an individual, it's a good night's sleep today.
All right, there you have it. All three of my guests today think that on balance, it was positive for the individual investor, for the individual tax saver, a taxpayer. Tell us what you think though, and let us know in the comment section. Do share and subscribe. Thanks so much for watching. This is BQ Prime.